So, Emmett, while we're waiting, is there anything that you would like to make sure? I'm just going to try and cover a basic, how do you quickly evaluate a deal? But are there any questions you'd really like me to try and cover?
The more I hear the information that the content of the lessons that you present, the more I get it. I'm always trying to figure out how can I do creative financing, along the lines of not having used my own money aspects of it. But the more I hear the formulas and evaluating like you were talking about the tertiary markets and stuff, that was pretty good. I wouldn't have known to ask about tertiary markets.
Good. I'm glad that helped. Hi, Travis. Hi, Rob. So it's about 6:30, and I'm going to wait one more minute, but I'm going to tell everybody we're going to start on time today because we actually have on running on another Zoom link, another meetup with two of our partners who are talking about successes and mistakes they've made. And so this was an error on our part to try and double schedule. So I think what we're going to try and do is to cover the bases on this one. And then next week, we're going to come back and we're going to try and do a little bit more analysis. And I may try and ask a couple of you to come in with potential deals that we can do a sniff test on, just so you get some practice. Does that sound reasonable to everybody? So I do apologize for for our mistakes here, that we didn't realize that the two kind of were overlapping. And next month, we're just going to do one. It'll run on Teaching Tuesday. It's going to run a little bit longer, or at least it can, and we'll answer more questions. And it'll be a combination of the Teaching Tuesday and our every third Tuesday meetup for residential real estate. And so we're going to try and make sure that we have some stuff that are applicable to both commercial potential investors and residential, because a lot of this stuff overlaps. So we're just going to try and be a little more careful. And so you do have my apologies, but that's kind of what the plan is. So how many people have we got on now, James? Do you know? Can you
Seven.
see?
Seven
All
people.
right.
Oh,
All right.
eight.
Okay. So James is going to log off here in about 10 minutes, about 6:45, and he's going to move over to the other one. And you're kind of stuck with me, who is not nearly as tech savvy with Zoom. And so I ask in advance for some grace if I goof up on this. All right. So we're going to wait one more minute and then we're going to get started on this. And you already see the slides up here.
Yes, I see the first slide.
All right, great. So while we're just waiting to get started, what we're going to try and talk about tonight, is I've used this for 20 plus years. I mean, we've kind of tweaked it a little bit, but basically it's a way to try and do a very quick basic analysis of, is this the deal you're looking at, even in the realm of possibility? And that's important because over the last couple of years, you've seen expenses, you've seen the price of properties go way up, and that means it's harder and harder to find a deal that works. So I think I'm going to go ahead and get started, and I'm going to go back and say what I said again, just real briefly. If you already heard this, you can I'm apologizing for saying it again, but we made a mistake and we kind of double scheduled. So we have a meetup on the third Tuesday of every month. And so James is going to leave here in about 10 minutes to go host that meeting with some of our partners. And I'm going to try and do this one. And we will maybe not have quite as much time to take questions, but I also don't want to cut anybody off. And so if we don't cover enough information, then we'll come back next week and we will do a couple of examples and practice on this so that everybody kind of gets a sense of what we're actually doing. And so I'm going to go ahead and get started. And what we're talking about this week is basically a first level analysis. So like I said, prices have gotten much more expensive. And so it's harder and harder to find deals that work for people. And so to try and save time for us to make a judicious use of our time, which is, if you're anything like me, that's what I have the least of in this world right now, is to try and be able to find very quickly if a deal is within a realm of possibility. And so what we've set up here, what I've set up here, like I said, I've been using this for 20, 25 years, is to be able to take a first quick look at a potential deal and see if it's in the realm of possibility. So it should not take more than 5 minutes. You are not, and I'm underscoring the word not, going down, trying to find out all sorts of information about this property. This is basically just looking at the price they're asking for each unit to see if we are anywhere in the ballpark of what we can afford. Okay. So in that, if the numbers we went up, if what they're asking, who's trying to sell this, is 20% or more than what we can pay, then we are basically just going to pass on it. That we may keep our eye out in case the price comes down, but we're not going to spend a lot more time on it. We need to be able to look at a lot of deals, right, in a quick and efficient manner. So most sellers, when they sell, are going to list the property somewhere around 10% more than what they'll accept. It's just a very typical broker kind of advice to sellers. It doesn't play out with people who are selling on their own, but most of the point, you have some negotiation room. So the best way to get a handle quickly on what the property's actually bringing in is through a copy of the current rent roll. We don't need rent rolls from a year ago. We need rent rolls from the last month or two, right? And that rent roll needs to have a listing of all the units. So some rent rolls will only, or some people will only send you a list of the units that are occupied. They're not going to send you units that are vacant. But for us to be able to do this, we need to have a listing of all units, occupied, vacant, and the ones that aren't paying. We need to know what each unit is paying, especially in the last couple of years, because a lot of people who have been in since the pandemic have been there for a year or two and rents didn't go up. And so they're paying one rate, because there were so few vacant apartments, because we couldn't evict and there weren't any new buildings going up, that the rents on the new units were way higher. And I'm talking 20, 25% higher. So you can't go by what the broker is going to say that here are the current rents. You need a rent roll that actually shows what each unit is currently paying, because that's going to tell you what your income actually is, right? And we need to know in that rent roll any bad debt. people who haven't paid, any vacant units. There also may be some people who are getting concessions, meaning they're doing a little bit of work for the property or something else. So you need to know, you also need to know people who've paid in advance. That's why you need a current rent roll that has all of that information in it. Some brokers are just going to send you the NOI, which is the net operating income, which is all income minus all expenses except the mortgage and the interest on the mortgage. The NOI to me is a good number. It's a good way to start getting a sense. But in the last couple of years, it's not quite as good because you really don't know what the expenses of property have been, whether they're too high, they're too low. You don't really get a sense of vacancies and bad debt and that kind of stuff. And remember, there were some people who hadn't paid for a year on some of these and you couldn't evict them. So you really, to me right now, what I need is a current rent roll. Sometimes if they give you a current gross income, we can use that. So that's kind of the only piece of information I really need and want right now is a current rent roll that has that information on it. So what we're trying to get a sense of is how much we can offer. And to get a sense on that, we really need to know what the net operating income is on that property. Because that's what the value is based on. And remember, the net operating income is income from all sources minus all expenses, with the exception of the mortgage and the interest on that mortgage. And in many cases, you're not going to get money that's being put away for reserves, right? All right, even a property is 100% occupied, we're going to take a 10% vacancy factor out of it. And that's going to be for turnover, it's going to be for bad debt. It's a way to make sure that we really are accounting for what this is. Almost no property I've ever seen is 100% occupied all year and that everybody pays when they're supposed to pay. That's why I'm going to take the income and I'm going to take off 10% of that income as a vacancy factor, bad debt factor, etc. What I will tell you is if in the rent roll you see that the vacancy factor is higher, meaning you have more than 10% vacancy and more than 10% bad debt, you're going to use that number to calculate. Okay.
Hey, Nicole,
Yes.
I'm gonna go ahead and hop off. Just from a technical standpoint, when you finish and you close the meeting, there'll be a little screen that pops up that says converting. Just make sure you don't click out of that or don't stop it, right? Just let it run. And when it's done, it'll let you know. And that's actually converting the recording into something that I can then edit for these guys and send out to them.
Do I have to rename it or anything?
Nope.
Okay.
All right.
All right.
Bye.
Bye. Thanks, everybody. Okay, so we need to get a sense of what we can offer for a property. And I'm typically wanting to buy a property at an 8% capitalization rate. And the capitalization rate, basically an 8 cap, is and the NOI, the net operating income, divided by 8%, by 0.08, right? That's going to give you the dollar amount of what we can basically buy. Now, if you remember, most people or a lot of properties, excuse me, brokers have been asking or trying to sell things at a 5 cap rate, a 6 cap rate. And right now, I just don't think we can do that at all. The cost of money on mortgages for if you're going to get loans is 6 to 6.5%. And you need some kind of spread between what interest rate the bank is going to charge you and what you are going to be buying it for, because that's going to have a lot to do with your profit. So that's why I'm saying we want to buy it at an 8 cap rate or be able to get there easily within the end of the first year. And we're going to practice this a little bit here, right? If there is a lot of upside that can be gained easily, meaning the expenses are way too high, there's a significant upside in rent, we may be able to do less. But frankly, what that means to me is that if I buy it at less than an 8 cap rate or being able to get there, then I actually have to do the work to get to that number. And so somebody's trying to sell me something at a price where I have to do work to make that number work. And I would much rather be able to be at a lower cap rate or a higher cap rate, not lower, so that the profit is mine. The work I do results in profit for me, not the seller, right? So other kinds of issues that are going to play into what I can offer are the down units. So if I have a number of down units, meaning they're just not vacant, but they need work done to them and therefore money put into them before I can rent them, that those don't really play into my numbers. Some properties I need to change the type of residence. And so some of this stuff is a little bit nuanced, but I don't have to worry about most of that right now. And I want that to be clear. What I'm just trying to do in this is to get a very quick sense of, are we in the ballpark with what the seller is asking and what I can pay based on the current rent roll. And we're going to look at that in a minute. All right. One of the things I do want to do early on in this is to go to some place like Rent-A-Meter, or to look in to talk to a realtor, or to look in the Google to find out what the current rents are for 1-bedroom and 2-bedroom apartments or houses, if we are buying a single family house or a duplex in that area. Because that's going to tell you, say somebody's selling or renting something at $1,200 a month, but the average rent is $1,400 in that area for a unit in reasonable shape, then I have a $200 a month up that I can raise the rents over a certain period of time. And so I do need to see where the rents are for these in this area at this address in average compared to what they're actually asking, because that is one of my easily added value adds that I'm going to be able to maybe buy something at less than an 8 cap. Okay. If you go to Rent-A-Meter, it is going to show you, you're going to put in the address of the property, right? And it is going to show you, ask you if it's a 1-bedroom or a 2-bedroom, 3-bedroom. And then you will see a little dial that has the median rent, the high end, and the low end. And you're going to be able to see the variation in the rents in the area, right? And I pretty much use the median, and I may be trying to be a little bit below the median just because I don't like turnover. But all we're using it for in this case is to figure out if we have upside on the rents. Okay. So what we're going to do now a little bit is we are going to do a little bit of a calculation, right? To do a little bit of an exercise. And I have a, in here in just a minute, I'm going to bring up another document that's going to show you how we figure this out. So this example is a 54 unit apartment building in St. Paul, Minnesota. They say it's 98% occupied. They're asking 5.8 million for it. If all units were rented all year and there was no bad debt, the potential gross income is $53,400, right? And they're reporting that their expenses are 50%, and we're going to use that. There are 22 one bedroom, one bath, that's 1,100, and 32 two bedroom, one bathroom that are rented for 1,400. So that's the exercise we're going to use. All right. This is basically the worksheet we're going to use. And you can see this. We're going to figure out what the scheduled income is, our vacancy factor, what that leads to in a gross income minus our expenses, and that equals our NOI. And then we're going to figure out what we can offer at a 10, 9, or 8 cap. And then is this something we can pursue further? So I know I have probably left a lot of people in the dust on this, but I'm going to come back to this and we're going to work through a worksheet.
Hey, Nicole,
yes.
I'm sorry to interrupt. I wanted to try and start the other meeting and it wouldn't let me do it without closing this meeting. So I've already let Jane and Sharon know that we're going to start that one right at 7. So we may not have time for questions, guys. This is not Nicole's fault. This is my fault completely 100%. So I apologize to you. But we're going to have to cut it off at 7. And then we can have, if you want, write down your questions. And next Tuesday, I'm sure she'll be able to answer them. So Nicole, I'm very, very sorry.
Okay. I was worried that this was going to happen.
Yeah.
So, all right. So we're going to try and see what we can do here. So one of the things we do want to send to people who've signed up for this, and we want to send them the document I'm going to pull up next, which is the worksheet, right? So I've got about 10 minutes. So I'm going to try and get out of this. So next week, what we're going to do is we'll come back and we'll actually work through a couple of these examples. And I don't know, I want to know if a couple of people on the group, I can't get everybody on the participant list up. Oh, there it is. If there's anybody on the participant list next week who'd be willing to come in and bring in a potential deal they see and let us work together. I'd like to get a couple people to volunteer if you would. That means you have to be on the call next week. Don't everybody volunteer at once.
Yeah, this is Travis. I can find something.
All right, that would be really great, Travis. Thank you.
Looking forward to
I can
it.
as well. Rob.
Rob. Okay, so Travis and Rob, you're going to come in with something. I don't care if it's a good deal, a bad deal, an indifferent deal. We're going to analyze it using this. All right. I would just point out that if you want to know more, we have a free webinar that's bit.ly passive wealth webinar that you can go in and see, and that we will post this call, such as it is, by Thursday evening, Friday morning on our YouTube channel, which is Multifamily Passive Cash Flow. I am going to get out of this. I'm going to stop sharing this one, and I'm going to bring up another document that we can share, that I can, let me see, where is it? Okay, here it is. Can everybody see that?
Yes.
Yes.
Okay, so I'm going to hit the highlights of this, and we're going to send this to you. This is the same thing you saw on the on the slide. So this is the same deal. It's 54 units, 22 units that are 1 bedroom, 1 bath, 32 that are 2 bedroom, 2 bath. They're asking 5,700,000 or 5,800,000. So what I'm going to do here, remember we said that the 1 bedroom, James, you have to keep me on time. You know I'm not.
Yeah, sure.
Is $1,100 a month times 22 units times 12 months in a year. That equals $290,000 when we do that math. There are 32 2 bedrooms. Our average rent for the 2 bedroom is $1,400. And there's 12 months in a year. So the potential gross is $537,600. If we add those together, we get $827,600. I'm going to take 10% of that because that's my vacancy factor off of that. And that's 82,000. That means my effective gross is somewhere around 744,840. Does everybody understand that so far? How we got there? That's the first part of this. Is there anybody that doesn't understand that? Okay, so now what we need to do, we need to take out the expenses in this. Now remember they said their expenses were 50%, but they didn't give us a vacancy factor. So I have taken out a 10% vacancy factor, and I'm taking that 45% of this income, this 744,000 is going to expenses, like management fees, like employees, like insurance, like taxes, all of those kinds of things. And so if 45% expenses means we should have a 55% that's left. So if I take 744,000 times 55%, because I've taken out my 45% for expenses, my annual income after expenses, so my NOI, my net operating income, is 409,662. Is everybody following me on that? Okay. So now I'm just going to round it for math, and that's going to be $410,000. Okay. All right, so now I need to figure out if I could buy this at a 10 cap. If I do 410,000 divided by 0.01, which is 10% cap rate, I'm going to be at 4,000,001. If I do the same thing at 9% cap rate, it's 455. So basically, as cap rates go up, the cost goes down. Remember, we said we want to be able to buy it at about an 8 cap or be able to get there within the first year. And so at an 8 cap, I'm going to take that 410,000 and divide it by 0.08. And I'm going to get 5,125,000. So that would be where I would like to be able to buy it around there. But I'm also going to calculate a 7%. Particularly if I have some upside, and that's 5,857,000, right? And they are asking 5.7 to 5.8. So I am at an 8 cap, I'm 5.125. At a 7, I'm 5.87857. Remember, we said though that we need to be within 20%. So is my 5.125, which is where I'd really like to be, within 20% of 5.7 or 5.8?
Nicole, you got about a minute left.
Yes.
Are we in the ballpark?
Yes.
Okay. So is this something, so this is where we can offer, we're going to offer somewhere around 5.1, but we can maybe go a little higher. Is this something you would want to explore a little further? Yes or no, folks out there?
Sure.
Okay, I think so too. So this is, if I am looking, we got about 2 minutes left here. I'm going to find these kind of deals more likely in the Midwest and the South and in tertiary markets than I am in the Baltimore, Washington, Chicago, Miami, New York kind of areas, right? Because they're asking and getting these really high sales prices. So remember, this is all I am doing. This is a 5 minutes or less to quickly go through this. If I am not within 20%, I'm going to write an email back to the broker and say, this is where I am, and this is about why I am where I am. If things should change, please let me know. So you always want to get back to the brokers. You don't want to leave them hanging, right? But this is all the work you need to do. All right, so next week, what I want to do is we're going to take a couple of examples. And we have, let me see if I can get the people up here again, the list of people. So it was Travis and Rob who agreed to come in with the potential deals. And we're just going to actually work this, okay? And we're going to see where we are with this. And so next week, we're just going to have Travis and Rob kind of run this a little bit and tell us what they have.
Nicheole, this is Rob. Would you want us to not analyze it at all beforehand, or yes?
You're more than welcome to do either. It doesn't really matter. As long as you understand what we're doing here and
Absolutely.
you can tell what the numbers are, then I think that we can kind of figure out if this is something to pursue further or not, right?
Okay, sure.
Guys, we really have to jump off. Thank you so much for attending. Totally my fault. I apologize for that. This will be up on our YouTube channel in a couple of days. If you guys want any questions about this, whatever it is before next week, or just questions in general, or you want a copy of this, just email me. I'll make sure. I took a screenshot of the participants, but it doesn't have your email addresses. So if you want to just shoot me an email, it's James@Passive Cash Flow for Life. And 4 is FOR. So James@PassiveCashFlowForLife.com.
All right, bye. Thank you.
All right, I'm really sorry about this, everybody. Well, we are going to have a fix for next month. All right, so we're signing off and we'll talk to you later.
Bye, everybody.
Bye.
Thank you, bye.